guidance that moves lives forward.
Welcome to another episode of Divorce Doesn't Suck. I'm Wendy Sloane, and today our 11th of our 12-part series, Mapping Your New Path Forward with attorney Melissa Needle of Needle Kuda Divorce and Family Law. Welcome back, Melissa. I can't believe this is our 11th installment.
I can't either. It's flown by. It really has. 11. Wow.
11. So the book's in the works, I imagine. But today is a very, very important subject, and I'm glad we're talking about this. Because so many people need to hear this, protecting a family business. Now we're focusing on Connecticut, so I'm sure in other states it's different. So I just wanted to mention that.
Yeah, it's different in every state, but generally the concepts are similar.
Okay.
So I think it will be helpful for anyone who's listening to the podcast.
So as we know, ending a marriage is hard, difficult. But when a closely held or family business is involved, it can make an already complicated situation even more difficult. So where do we start here? What do you think?
So typically, if someone comes to see me and there is a small business that's involved with the family in some manner, or a family business that's involved in some manner, I know that it's going to add to the complexity of the divorce. It adds another layer. And the reason it adds another layer is because a business that is owned by either spouse, either 100%, 50%, 25% is an asset. And that asset has to be valued. And there are a lot of different curves that can come with owning a small business or a family business where one spouse has a lot of control over how that business is run and managed. Mm-hmm. So if someone comes in and tells me that there's a small business involved, the first thing that I will say to them is it is likely that we are going to have to hire a forensic accountant so that person, expert, can review the information related to the business so that they can come up with an opinion as to the value of the business. So that's really the first step, is to make sure that you have a qualified expert who not only will understand how to review the books and records of the business, but will be able to testify, if need be, in a credible way in front of a judge. And a lot of these experts sort of talk in their own language. And you need someone, an expert who's a good communicator, who can sort of dumb things down for those of us that aren't experts, that aren't accountants, that don't deal with profit and loss statements, and those types of information on a day-to-day basis. So those are the types of experts that I look for. And if you hire an experienced matrimonial lawyer, they're going to know the ins and outs of hiring the right expert if there is a family business involved in the divorce.
So does it matter how long, if the business started before you got married? Does it matter? Talk about that a little bit.
Yeah, that's a really good question. And that really is sort of state specific. So my response to that is, in Connecticut, at least, it wouldn't matter. And generally speaking, I think in many states, it wouldn't matter, because not only does the business itself have a value, but oftentimes it will throw off income as well. And any expert that you hire will also make a determination about the accurate income that the business generates. And when an expert is hired, they use different types of approaches to determine what the value of the business is. And I don't know if you want me to explain the different types of approaches, or if you have any other questions before we get to that topic.
No, I like it. That would be great.
Okay. So there are different types of approaches depending on the type of business, but generally speaking, a forensic accountant who is retained to value a family business or to make a determination about reasonable compensation of the spouse who works within that business would use one of three methods to formulate their opinion. The first method is what I call the asset approach. And that uses a simple formula to determine value. So it basically weighs the assets of the business against the liabilities of the business. So, for example, if someone owns a construction company and that company owns machinery like, backhoes and dump trucks, the business appraiser that you hire, the expert, will determine the value of the assets and have to weigh that against the liability. So if there's loans against the business or loans against the trucks or machinery, that will have to be taken into consideration. And although it is probably the most simple approach, there can be some complicating factors. You have to get appraisals for some of the assets, which can be a little bit tricky. And you also take into consideration things like depreciation, which can be a little bit complicated and not so straightforward. So that's one approach, the asset approach. The second approach is the fair market value approach. And when I'm describing things to my client, I like to say that the fair market value approach is similar to what realtors do when they use comparables to determine the value of your home. So, for example, if I wanted to list my home for sale, a realtor would come in and to help me understand the value or the amount that I should list my house for sale, they're going to do some research by looking at other homes that sold in my neighborhood that are similar in size and year, etc. And likewise, if a expert is using the fair market value approach, they will do some research. They'll have to understand what type of business it is that they are valuing. They'll have to understand the gross revenue that the company brings in. And they're going to compare that to sales of other businesses that are similar to come up with a opinion as to value, what the fair market would be if the company were going to be sold. Okay. So that's the way the fair market value approach works. The third approach is called the income approach. And the income approach is probably the most commonly used approach in determining value. And of course, it depends on the type of business and the situation. But the income approach is basically when an expert will take historical business information and formulas to predict cash flow and profits as a way to place a value on the business. So they're going to have to look at detail as to, what the company does, how much income it generates, what are the expenses, and then they're going to look at certain formulas that they are told to use that comply with certain accounting principles. And based on what the income or profit of that business is, they plug it into these formulas and they come up with a opinion as to value. And so those are the three different approaches that are most commonly used. There are other sort of factors that are taken into consideration. And one of those factors that I think it's important for the listeners to understand is there are certain factors that discount any value. So if a expert comes up with a value of $10 million for the value of a family business, that value may be discounted for something called lack of control. So if your spouse owns, let's say, 40% of the business, they don't have control over how that business is run. And as a result, that $10 million valuation will be discounted for lack of control. And so it won't be worth $4 million. So 40% of 10 million is 4 million. It might be discounted even further because you or your spouse don't have control over decisions related to the business. Another discount is for discount for lack of marketability. And that's basically saying that there's not a large market that would purchase the business. And, it could be a very niche type of business. And in that case, certain discount factors would be applied to the value to reduce the overall opinions of what the company would be worth. So it's important that your listeners know that hiring a very good lawyer, divorce lawyer, who could then retain an expert who really knows what they're doing, because it can be very complicated. There's a lot of different information that has to be reviewed. And a lot of different discounts and approaches, and everything has to be just right. If one calculation is off, it's going to throw everything off. So it's really important that you get the right experts in place, because the value of the business can be a very big part of the marital estate.
I was going to say, this is a huge asset. If you just tuned in, we're talking protecting a family business in Connecticut divorce and just in general in divorce with Melissa Needle of Needle Kuda Divorce and Family Law. We'll take a break. We'll be right back. Needle Kuda Divorce and Family Law attorneys have helped Connecticut families through this process for over 30 years. They understand divorce is so much more than the legal dissolution of a marriage. Divorce is about finding and accepting a new path forward, defining your new family, and securing an enforceable agreement that secures your future. Their experienced attorneys and paralegals are first and foremost committed husbands and wives, mothers and fathers, daughters and sons, who are all devoted to protecting Connecticut families. Put the strength, wisdom, and experience of Needle Kuda behind you and move forward with confidence. Visit them at needlekuda.com. We're back. So do you find that most people, Melissa, do they continue in the family business together because of the financial situation, or does it all depend?
It really, that's such a good question. And I have so many clients, especially when it's a small family business, ask me, well, why are we valuing this? How are we going to divide it? And that's sort of, once you figure out what the value is, you then talk about logistically, what process is going to be used to make sure that it is equitably divided. And again, there's probably three different approaches that are generally used. Mm-hmm. And one approach is the family could continue to co-own the business together. So let's say there's a husband and wife who own a dental practice together. And if the divorce is in very high conflict and they want to continue in that dental practice, then certainly they can continue to do that. And you can come up with an arrangement where the profits are equally divided and the expenses are shared in some sort of manner. So co-owning is a little bit unusual, but it certainly can be something that's done as part of a divorce agreement. If you go to trial, it is very unlikely that the judge will order that a business be co-owned, because let's be realistic here. You're getting a divorce. You don't get along anymore. You don't want to be partners anymore. That's what getting a divorce is. So the idea that you're going to continue to co-own a business is really the exception.
Or one person could start to sabotage the business.
There's a lot. It's a recipe for trouble, for sure.
Right,
And it's not something I would typically recommend, but you never know who's going to walk through the door and what their relationship is going to be like. So never say never.
right.
The second type of approach, when there's some sort of business that's within the marital estate, is where the business is liquidated, or in other words, it's sold.
Okay.
So if someone owns, for example, I don't know, a construction company, and they want to sell it, they could sell it. And whatever the net profits are after they pay all of the expenses and taxes, that could be divided in some manner. And that does happen occasionally. And it may happen because the third approach is a buyout approach. And that's the most common, where one party retains the business and pays out the other spouse for whatever the value of their portion of that business is, taking into consideration all the discounts, etc. If a buyout can't be done because a party can't afford it, then sometimes we go back to the liquidation method. But a buyout can be set up in many different ways. So if someone doesn't have the ability to pay their spouse in the year of the divorce or at the time of the divorce, then oftentimes what will be done is we will approach it so that the buyout is done over a number of years.
Yeah, that makes sense.
So, for example, in the let's say that the couple has a dental practice together, okay, and the wife is going to continue to own the dental practice, and the husband's going to move to a different state and start his own dental practice. And if the dental practice, the total value of it was, let's say, $2 million, and that includes the discounts and everything, and the wife owes the husband $1 million, but she doesn't have $1 million to pay him on the date of divorce, she could maybe pay him $250,000 over a 4-year period, which might be something that is more realistic for her to pay, and something that the husband might say, that's fine with me, as long as I get that first 250 so that I can, pay for some space and set up my office. So that's typically most common. The way it's done is some sort of buyout. And usually that buyout is paid out over time. And if it is paid out over time, then the person who's receiving the payments can also request that some sort of interest be attached to the money that's owed, which would not be an unreasonable request. And so that's normally the way that we approach closely held businesses within a divorce. There are sometimes other considerations, such as are there other owners to the business, and what is going to be their position? For example, when your expert wants to come to the office of the business to review all of the books and records and finances of the business. So if your spouse or you own 30% of the business and you have a partner who owns 70%, and the partner says, absolutely not, under no circumstances do I want this information revealed. How do you approach that situation? So there can be some challenges associated with this, and every case is different. But generally speaking, the first step is to make sure that you're upfront with your lawyer and explain what the situation is with the business. The next step is to make sure that your lawyer hires a qualified expert who not only will know how to value a business and the different approaches and discounts, but an expert who is known to be credible to the court. And I feel it's particularly important for an expert who is a good communicator, and doesn't sort of speak accountant language, because that can be very challenging.
Very complicated. It
And
sounds
very,
like it's very complicated and so many parts, so many moving parts. What happens if a couple gets married and then a business is started during the marriage or right before the marriage, and only one person is involved?
yeah, so that's usually what happens. There are occasions where husband and wives do have businesses together, but I think it's more common than not that one spouse is working in the business and the other isn't. And that doesn't matter. It's still part of the marital estate. And if you are the spouse that doesn't have any information at all about the business, you have very little knowledge, that's okay. I mean, all of that information is going to be, all of the important and relevant information, I should say, is going to be something that will be reviewed and analyzed by your lawyer and by your expert. So typically what will happen is I will hire an expert and I will have, several discussions with the expert, and the expert will give me some guidance about the information and documents that they need to review based on the type of business it is. And then I will request that the other side provide that information to me. When I receive that information, I will then go back to my expert and give him the information and ask him to review and analyze it. And that might lead the expert to say, well, I need more information, or I need to go to their offices. I need to speak to the bookkeeper. I mean, it can lead to a lot of different activities that need to happen. And so if you don't know anything about the business, it shouldn't make a difference, as long as you hire
The
a
right attorney.
experienced lawyer who can guide you and navigate you through the complexities that exist.
We've talked about that so many times on these episodes too. Hiring the right attorney is so essential because there's just so many things to be involved. And if you don't have the right attorney, things like this this is one of the biggest assets in the divorce.
Yes,
Or a
and
business.
it's very complicated. And if there's one spouse who is intimately involved with the business, then they have the ability to manipulate information to their benefit. And you want to make sure that that doesn't occur. And that's why it's so important to have an experienced lawyer as your quarterback to navigate you through these types of situations.
No, and so many different situations come up, I'm sure, with regard to this. What a great topic today.
Oh, I'm glad. Yeah, it's a little bit detailed, but I think it's so important. And there's so many people out there who are involved in some manner with whether they're family or small businesses, and it's really a critical part of the marital estate.
Another thing we could talk about on another episode is about when it's money that's coming in from other family members or estates that come in and things like that. So important to talk about that as well. Who has the right to that?
Absolutely. That is important as well.
We'll touch base on that next time. Protecting a family business. Thank you so much, Melissa, again, for this
Thank you, Wendy.
very important topic.
Always a pleasure.
Thank you.
Guidance that moves lives forward.